Good morning, everyone. Thank you for spending part of your day with us and for your support of Intuit over the last year. I'm going to share how our AI-driven expert platform strategy translates into our financial results and how our financial principles continue to guide our thinking. Similar to what I've done in the past, let me start with a look back. On the left of the slide, you'll see the key objectives we outlined at last year's Investor Day. The right side shows how we performed against those objectives. Our performance in 2021 was strong across each of our businesses, and we achieved our goal of double-digit revenue growth, with 25% growth at the company level, including Credit Karma, which contributed 11 points to growth. Our combined platform revenue, which includes QuickBooks Online, TurboTax Online, and Credit Karma, grew 39% to $6.6 billion in fiscal 2021. And we grew GAAP operating income by 15% and non-GAAP operating income by 31% for the year. We also remain pleased with our ROIC and consistent increases in our dividends. Now, Sasan mentioned earlier that we've taken our aspirations and turned them into bold goals for 2025 because we believe we can aspire to even greater things. And the goals are around prosperity, reputation, and growth. Our prosperity goal is to double the household savings rate for our customers. In the United States, this rate is 14%, and for those on our platform, it's 17%, which is approximately 1.2 times the average household savings rate. For small businesses, we want to increase the success rate by 10 points above the industry. According to the Bureau of Labor Statistics, the 5-year survival rate for small businesses is 50%. Close to 50% of businesses fail within the first 5 years. The 5-year survival rate for QuickBooks customers was 69% in fiscal 2021. On reputation, we want to be the best in class as one of the most reputable companies in the world, and we've made significant progress against our reputation goal. You'll notice that our reputation score in fiscal 2021 went down slightly from last year, mainly due to a tough macro environment. But our score remains higher than many of our tech peer companies whose average score was down 6 points from last year. And lastly, we're growing our customers and accelerating our revenue growth. We use our financial principles to guide the decisions we make. Let me provide a bit more color on each. First is double-digit organic revenue growth. We continue to see a large opportunity ahead in serving consumers, small businesses, and self-employed to grow the company's revenue double digits as we expand the set of customer problems we address through a broader set of products and services. You'll notice that we added ARPC growth here in addition to customer growth as we're increasingly focused on growing higher value customers. Next, we focus on growing operating income dollars faster than revenue. It's good discipline for us to approach each year with expenses growing slower than revenue. While we're not driving towards a particular level of annual margin expansion, we are seeing the leverage of our platform. Next, we deploy cash to the highest yield opportunities, targeting a 15% ROI over 5 years. This principle is key to managing our business for both the short term and the long term. Whether we're looking to expand into new products and services, considering acquisitions, or as we invest more deeply into our core technology platform, this threshold is key to making all internal investments that will deliver for years to come. After this, we return excess cash to shareholders. This speaks to our stewardship of how we handle the capital we generate and comes in the form of buybacks and dividends. And then finally, we manage to a conservative investment-grade balance sheet that can sustain our business through all types of economic cycles. And this has served us well in the recent past through the pandemic, which allowed us to lean in to emerge even stronger. I mentioned in my opening that our combined platform revenue is driving accelerated revenue growth, and we expect this will remain the case going forward. In 3 years, we expect more than 80% of our revenue to come from these offerings. We'll continue to support customers using our desktop offerings as these remain very profitable, which allows us to invest in new products and services. As we've shared before, we have a highly predictable revenue model and expect more than 80% of our revenue this year to come from existing customers. And with 95% recurring revenue, MailChimp should increase this after the transaction closes. Customer growth remains an important part of our strategy across all of our businesses. Starting with QBO, on the left side here, you'll see total paying customers. This includes QuickBooks Online, our desktop subscribers, and desktop unit sales. This fall, we made a decision to transition to a subscription model for our desktop lineup with the 2022 release. This means we will be exclusively selling our desktop offerings as a subscription beginning in fiscal 2022 and no longer be selling desktop units. We've already been seeing our customers gradually migrate to subscriptions, which allows them to be on the latest version of the software while also providing access to customer success for an improved customer experience. Once again, our total net adds grew in fiscal 2021, and our desktop base remains relatively sticky, but we continue to see the majority of customers who are new to QuickBooks choosing QuickBooks Online. On the right side, you'll see we grew total QBO subscribers by 16%, excluding subscribers from the discontinued TurboTax and QuickBooks Self-Employed bundle. And we grew our highest value subscribers more than 20 points higher than overall QBO subscribers. As Alex shared earlier, we're opening up new opportunities for growth by broadening who we serve, how we serve them, and what we serve them with. We still have a large runway ahead in the US as well as internationally, with a broader set of customers from the self-employed to the small business mid-market. Moving on to the consumer group, we continue to see traction with our goal of growing our share of total tax returns. This year again was unusual with the late opening of the tax filing season and the delayed IRS filing deadline. But we're pleased to drive growth in our share of IRS returns by approximately 1 point to 31%. We continued to transform the $20 billion assisted segment with TurboTax Live, accelerating total customer growth by nearly 100%. This contributed to an 8% increase in average revenue per return this season. TurboTax Live is now a meaningful revenue contributor to our business, and we continue to see plenty of runway ahead. We also grew the base of customers paying us nothing by more than 6% this season to over 17 million filers. Moving to Credit Karma, we have a large $85 billion TAM with significant opportunity to increase penetration in each of the 3 verticals that Ken described earlier, with just 5% share of credit card and personal loan transactions on the platform today. The business exited the year with revenue at a record high, and the team is focused on continuing to drive growth through innovation. On the right side, you'll see the key drivers of Credit Karma's revenue growth. First is members, which reached an all-time high of 121 million and grew 8%. Second is average monthly active users, a measure of engagement, which ended the year at 41 million and grew 6%. And third, average revenue per monthly active user of $28, which grew 29%. As we innovate for our members and expand beyond core verticals and into the growth and emerging verticals, we expect to drive higher member engagement and higher average revenue per monthly active user. Everything we do is customer back, and across all of our businesses, we're able to improve monetization as we increase the value we're providing to our customers. ARPC is not something that we manage to. It's the output of the various decisions we're making regarding customer and revenue growth. We see an increase in our ARPC this year across all of our businesses. As I mentioned earlier, we're increasingly focused on growing higher value customers, and we're seeing traction with this strategy as we expand into the mid-market, virtual expertise, and omni-channel. Going forward, we expect QBO worldwide ARPC to continue increasing. In the US, this will be driven by our maturing customer base and increased monetization via online services and higher value offerings like QBO Advanced and QB Live. Outside of the US, we expect to see an increase in ARPC from our maturing base and lower promotional activity. Turning to QuickBooks Desktop, we saw an increase in ARPC due to the mix shift of customers from outright units to subscriptions, and mid-single-digit growth in our mid-market desktop enterprise solution, which we expect to continue. And in the consumer segment, we expect to see an increase in ARPC as we continue to transform the assisted category. Durable revenue growth and disciplined investment have driven our operating income growth historically, and we remain focused on both going forward. On this slide, you'll see our long-term expectations for the P&L, which are unchanged from last year. We expect each expense line to be flat to down as a percentage of revenue over time as our platform evolution enables new drivers of operating margin expansion. However, we acknowledge that GAAP operating income will grow slower than revenue in fiscal 2022 due to the decisions we made around stock-based compensation and the impact of Credit Karma. We're confident these are the right decisions to drive long-term growth. A key element of our financial principles is to grow operating income dollars faster than revenue. And as we lean into our platform strategy, we see the opportunity for margin expansion over time. We are increasing the velocity of development on the platform to deliver even faster benefits for customers across all of our products and services. This includes our AI capabilities, our expert services, money movement, and fraud and risk capabilities. We're scaling our customer success platform across our products and services to more efficiently serve our customers leveraging AI. And our go-to-market capabilities leverage a common infrastructure to effectively target and manage the sales and marketing process efficiently. At a high level, our approach to investment has not changed. We invest in the highest yielding opportunities with a focus on investing to drive durable growth and accelerating speed and velocity, all within the context of our financial principles. Making deliberate trade-offs to allocate investment to the best opportunities remains a core element of our DNA. We continue to prioritize investments in our big bets, and we'll be allocating more of our investment dollars into these areas to drive durable growth over the long term, while being very deliberate about investments in core innovation and running the business. Now, I'd like to provide some additional context around our operating margin expectations. As I shared during the fiscal Q4 2021 earnings call, we continue to see opportunities to leverage the platform and drive margin expansion over time. However, our fiscal 2022 guidance implies GAAP operating margin declines in fiscal 2022 versus fiscal 2021. This is due to an increase in the stock-based compensation expense. There are two elements driving stock-based comp expense higher in fiscal 2022. First is the investments we're making in stock comp to attract and retain talent, which is driving more than 50% of the increase year over year. And second is the full year impact of the Credit Karma acquisition. Our fiscal 2022 non-GAAP guidance implies operating margin expands about 60 bips. This marks a point of expansion on average each year since fiscal 2019. It's important to us to be effective stewards of capital. This includes investments in organic growth drivers as well as acquisitions to accelerate progress against our strategy, whether it be in talent and technology or to help fill out our product roadmap. Over the last 4 years, we've returned approximately $4 billion to our shareholders through share repurchases and dividends. We repurchased approximately $1 billion in shares during fiscal 2021, and I'll touch more on repurchases in a minute, as this remains an important tool to return capital that can't be invested profitably in the business. As for dividends, our board declared a 15% increase in the dividend for fiscal 2022. And we continue to expect our CapEx to remain at approximately 2 to 3% of revenue. Our philosophy and principles on share repurchase remain consistent with what we shared in the past. That said, let me quickly remind you how we manage our program. We limit repurchases to cash that can't be profitably invested in the business or used to make prudent acquisitions. We apply rigor to this process by utilizing a smart grid to drive various levels of repurchases at each price range, with a goal to exceed our cost of capital on average. At a minimum, we expect to offset dilution over a 3-year period. Subject to market conditions and other factors, our aim is to be in the market every quarter. Looking ahead, we're pleased to be guiding double-digit revenue growth of 15 to 16% for the company in fiscal 2022. This guidance is what we released back in August, so there's no changes here. We exited the year with strong momentum across our businesses, and we expect this to continue as we make our way through fiscal 2022. Here is our guidance for operating income and EPS. No changes here versus what we communicated in August. We remain focused on making the right investments to drive durable growth across our businesses and remain committed to growing operating income dollars faster than revenue over time. Moving on to the next slide, I'm very excited about our momentum. And as you've heard from Sasan, we have many innovations across the horizon that are not only delivering strong results today and tomorrow, but 3 years plus out. We've planted the seeds for the future as we focus on durable growth across our business. In summary, we had a dynamic fiscal 2021 and are set up to continue our strong performance for fiscal 2022 and beyond. Our AI-driven expert platform unlocks opportunities to better serve customers across our businesses as we focus on offering them the products and services that solve their biggest problems. And we're excited about MailChimp strengthening our capabilities and accelerating growth after close. I look forward to connecting with you all throughout the year and keeping you apprised on our progress.